Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Yeti reported earnings this week, and like a lot of companies, it's growing a little bit, and that's great in the consumer market. I think the company's managing its business and its inventory very well, but costs are still rising on the operating expense side. And so that was kind of the concern for investors. This is a stock that I have never owned, but I really love the brand. So I would love to see this be a value stock because I think that could be a great position for the company long term, make for a great long term investment. So that's the lens with which I want to look at first quarter results. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get right to the results. And you can see here that revenue was up 3% in the quarter, despite the fact that there were some recalled products that they stopped sales of. $302.8 million was the revenue number. Direct to consumer sales increased by 7% to $167 million. So a lot of customers are finding Yeti on its own website instead of going through retailers. That's generally something you would like to see with a lot of these companies, as long as it's not too costly. And I'll get to some of those costs in just a second. Wholesale channel sales decreased 1% to $135.8 million. Wholesale is always a challenging segment because you have the end user demand, and then you also have the fluctuations in how much inventory any company is willing to hold. So even if end user demand is the same, you can actually have a decrease in sales if a retailer's inventory is going down. So keep that in mind. Nothing real surprising on the segment sales. Drinkware sales were up 3%. Coolers and equipment up 1%. So they're kind of growing in the same rate. And gross profit increased 5% to $161.9 million. 53.5% of sales is the company's gross profit. That's just astounding for a consumer goods company to have over 50% gross margin. So I think that's one of those things that's always really impressive with Yeti. But here's where things get a little bit more concerning. SG&A expenses were up 21% to $146.8 million. And as a percentage of sales, were 48.5% of sales versus 41.4% a year ago. Now, management explains that a little bit, saying that a lot of these are variable expenses. So things like advertising, things you can cut back on in the future. And there was investments in future growth, warehousing costs, and marketing expenses. So reading between the lines there, what I'm concerned about is the company is spending a lot on advertising and marketing to basically just maintain flat sales, and they're basically giving up profitability as a result. I think that's something we're going to have to keep an eye on. On the balance sheet side of things, there's just a lot of really great news. Cash was $168 million, up from $100 million a year ago. Inventory dropped. This is something that's going to help cash to $147 million from $413 million. Any consumer goods company and a company that's manufacturing an actual physical product, you're really going to have to keep an eye on inventory levels, because that's where companies really get in trouble and have to report write-downs and losses if they can't sell through their inventory. So love to see inventory falling that much. And total debt was down to $84.4 million. So not a significant amount of debt for Yeti. Management also reiterated their outlook for the year, so sales up between 3 to 5% and adjusted net income of $2.12 to $2.23 per share. So that puts the stock at a price to earnings multiple a little under 20 on an adjusted basis. Remember, that adjustment pulls out primarily stock-based compensation. No major surprises here from Yeti, but I think what's concerning a little bit is that those operating costs are going up, especially the SG&A side of things, as sales are flat. So there's no operating leverage in the business, meaning if revenue rises 3%, then net income rises 6% or 8%. We're actually seeing the opposite happen at Yeti. And so that's really my concern right now, is that the operating expense line is going in the wrong direction. Especially with a direct-to-consumer business, you should see that being something that the company can leverage because it has a little bit better margins. The other thing is the valuation of the company is just not all that attractive given the growth rate. That adjusted earnings per share number puts the price to earnings multiple a little under 20. But for a company that's growing at 3%, I don't think that's a great valuation. I'd like to see that price to earnings multiple fall to more like 10 to 13 times. That's a much more attractive valuation for a slower growth company, even though this is a great brand and a very high margin product. I just don't see this being a company that's going to double revenue over the next 4 or 5 years. It's just in a very mature phase of the market right now. Yeti's results were okay, not great. And I think the only challenge for investors is that the stock is just not all that attractive from a valuation standpoint. So That's what I thought of the results, but what did you think? Leave your comments in the comments section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.